Attendees are in listen-only mode.
Welcome to our webinar, Tax Efficient Succession Planning for Owner-Managed Companies. My name is Sharon Bedford. I am a tax partner at James Cooper Creston, and I am joined today by Mark Gregory, an experienced senior manager within our business tax team.
Hello everyone.
Many businesses reach a stage in their development where they need to consider succession planning. Perhaps the most common reason is because the owners are nearing retirement, but there can be other reasons too. Deciding on the next steps is not always easy, and a large number of commercial factors may have to be thought through. Tax is only one of the considerations, but nevertheless it can be an important one. In this webinar, we're going to look at some of the tax efficient options available to business owners to ensure they are tax ready for succession. So what we're going to cover? Well, firstly, we will provide details of two important tax reliefs, entrepreneurs relief and business property relief. We will then give an overview of the tax implications of passing shares to family members, and then finish by looking at some of the available opportunities to involve employees in the future ownership of businesses. This webinar is not going to go into details regarding the tax implications of selling the family company more generally. This will be covered in our webinar, Preparing Your Businesses for Sale, being held on the 21st of November, so something to pencil into your diaries.
Thank you, Sharon. As Sharon has mentioned, we intend to focus on two particularly important and potentially valuable tax reliefs. We shall now move on to delve into a little more detail and the key attributes of these reliefs. I expect that all of our listeners will be aware of Entrepreneurs Relief, which was introduced 10 years ago to reward owners of businesses for showing an entrepreneurial spirit. Entrepreneurs Relief is a capital gains tax relief available to individuals who make a qualifying business disposal, which is essentially the selling or giving away of their business. Very broadly, when an individual disposes of their company shares, the profit realised on those shares is charged to capital gains tax. The impact of Entrepreneurs Relief is to reduce the rate of capital gains tax applicable to that profit from 20% to 10%. Therefore, under current rules, the relief can save a business owner up to £1 million of tax during their lifetime. Every individual has that lifetime cap of £10 million worth of capital gains that Entrepreneurs Relief can be applied to and achieve at a lower rate of 10%. Entrepreneurs Relief is available to all individuals where the qualifying criteria is met. You will see from the slide on the screen that there are three qualifying conditions. It may seem that meeting only three qualifying criteria suggests that this tax relief is simplistic, but as is often the case, there are various pitfalls and complexities to the practical application of the relief. It would not be possible to cover all of the potential nuances and circumstances in this webinar, but I will delve into some common issues. It is important to note that to qualify for Entrepreneurs Relief, the three conditions must be met throughout the 12-month period, which finishes on the date upon which the shares are disposed of. The first condition is that the individual disposing of the shares must be either an employee or an office holder of the company whose shares are being disposed of. A common structure in owner-managed companies is where a spouse or family member owns shares in the company. It may be the case that a simple piece of planning, such as making an individual an employee or office holder of the company, may enable them to qualify for Entrepreneurs Relief. However, I should stress that this role should be more than in name only. Whilst HMRC do not consider that there are any minimum hours or minimum salary requirements to an employment or office, there are a number of legal points that require consideration. These are points such as minimum wage laws, pension enrolment laws, and the legal responsibilities and duties of holding such an office. For the next qualifying condition, It is worth highlighting that owning 5% of the issued share capital of a company will not necessarily be enough to qualify for entrepreneurs relief. It is also necessary for the individual to own 5% of the voting rights in the company. This may not be the case if non-voting shares are an issue. The final condition is an area which we often come across in practice, and I will now go into a little more detail of what constitutes a trading company. For the avoidance of doubt, when I refer to a trading company, this also encompasses trading groups for these purposes. Often trading groups have a non-trading holding company at the top of their structure, and if so, it is likely that individuals will own shares in that holding company. However, rather than assessing the entrepreneurs relief position with reference to the standalone non-trading holding company, the position is assessed in the context of the whole of the group's activities. Now, the definition of a trading company is a company carrying on trading activities whose activities do not include, to a substantial extent, activities other than trading activities. That definition initially poses two questions, namely, what is the meaning of substantial, and what activities would be considered non-trading activities? The term substantial is not defined in legislation, so we must look to HMRC for an interpretation. For the purposes of these provisions, HMRC considers substantial to be more than 20%, meaning that at least 80% of the activities must be trading activities. But this itself poses the question, 20% of what? The 20% test is applied to a number of different criteria depending on the facts and circumstances of each case. These criteria include the income of the company, the asset base of the company, expenses incurred by the company, or management time spent by the company in managing these activities. HMRC have stated that the failing of one of these tests would not necessarily mean that the company will not be considered a trading company. Rather, HMRC will look at all of the facts and circumstances in the round when making a decision as to whether the company is trading. I would expect the question of whether an activity is undertaken for the purposes of a trade to be fairly obvious. For instance, a company may buy some land. If the company is a property developer and buys the land as trading stock, the buying of the land would probably count as a trading activity. However, if a company buys land to earn future rental income or for potential capital growth, then the buying of the land would not normally be a trading activity. There are circumstances where activities which yield investment income could be undertaken in the course of or for the purposes of a company's trade. An investment may be so closely related to the conduct of a trade that it effectively forms an integral part of that trade. For example, a travel agent may be required to keep a fixed level of cash on deposit for bonding requirements. This poses an interesting question of whether surplus cash arising from trading activities but held in an interest-bearing account would be viewed as an investment activity or a trading activity. The short-term lodgement of surplus funds in an interest-bearing deposit account could count as a trading activity if the funds are earmarked for particular trade purposes, such as to meet some working capital requirements or to expand the trade in the near future. However, the long-term retention of significant earnings generated from trading activities may itself amount to an investment activity. For instance, if the funds are locked into a long-term deposit account or invested in a high-risk fund, that may suggest that the cash is not actually available for the trade. Therefore, whether a cash surplus held on the balance sheet is considered a trading activity is dependent on how the funds are held and what the company's intentions are for spending those funds. When you are making succession plans for your company, it is possible that there is an effective disposal of your company shares, in which case entrepreneurs relief will likely minimise your personal tax liability. We've included a few planning points on this slide so that you can start to think whether or not you may need to undertake some additional work to ensure you maximise your entrepreneurs relief. I will reiterate that entrepreneurs relief can result in a significant tax savings, but the qualifying conditions must be met for at least 12 months leading up to the share disposal. And so any planning must be identified and undertaken sufficiently in advance of any disposal. Firstly, if you consider the balance of activities undertaken by your company, if your company or group of companies do have substantial non-trading activities, then it may be the case that planning can be undertaken to improve the entrepreneur's relief position. A demerger is one such planning tool that could be of assistance and is a consideration that we see in practice more and more often. Indeed, Sharon and I could talk about the complexities of demergers for several webinars. Very broadly, reorganising the company activities through a demerger can have the effect of tax efficiently splitting the company's trading and investment activities into separate companies, which are not in a group structure. The investment company would not attract entrepreneurs relief, but the trading company should now meet the trading requirement and so may qualify for entrepreneurs relief depending on the other qualifying conditions. Part of the review of the balance between investment and trading activities will encompass the consideration of cash balances held by the company. As referred to earlier, the categorisation of a cash balance may be dependent on what you do with that cash, and therefore care must be taken. Another action that can be undertaken now is for you to assess the existing shareholders of your company and consider whether they will qualify for entrepreneurs relief. This may be particularly pertinent if you are considering passing on your company and you expect the value of the business to exceed your own available personal lifetime entrepreneurs relief cap of £10 million.
Thanks, Mark. So if you recall, we said we'd also touch on business property relief, which can be really valuable relief when you're thinking about succession planning, especially when you want to involve family members. So Mark has explained that entrepreneurs relief can lead to capital gains tax savings. Business property relief, on the other hand, is an inheritance tax relief. The rules are pretty complex, but in general terms, currently there is 100% relief on certain business assets, and that includes shares in unquoted trading companies. What this means is that the value of the company's shares does not add to the value of an estate when calculating the amount of inheritance tax due on death. Or to put it another way, shares can be passed on inheritance tax-free. Please note, though, that to qualify for BPR, the shares must have been held continuously for at least 2 years before someone's death. In the context of succession planning, it is important to note that business property relief, or BPR, does not only apply to estates on death. 100% BPR relief can also apply to lifetime transfers of shares in an unquoted family company. What that means is so long as a transferor does not die for 7 years after making the transfer or the gift, then there should be no further IHT on death. If there is a death within 7 years, there should also be no IHT if the shares are still held by the transferee. However, if the shares have been sold in the meantime and they've not been replaced by other qualifying business property, there could be a clawback of some or all of the BPR relief. Similar to the rules for entrepreneurs relief, to qualify for BPR, the shares must be in a trading company or group. The test here, though, is slightly different. This time, the proportion of excluded business activities must not exceed 50%. You recall Mark talked about the 20% rule. Excluded business activities for BPR relief include dealing in shares, dealing in land and buildings, and holding of investments. The 50% test, though, is again tested in the round with reference not only to assets, but income and time spent by management. The consequences of failing the test can be pretty costly. Therefore, if the company has mixed activities, or you have a group with different subsidiaries doing different things, this is another reason why consideration should be given to splitting or demerging the trading activities, as explained by Mark. Unfortunately, also, that isn't the end of the story. Even if the shares themselves qualify for BPR, the relief will then be restricted if the company has assets that are not used in the trade. These are known as accepted assets. You will see the formula that's used to calculate this on the slide. The effect is actually that inheritance tax becomes due on the value of the accepted assets within the company. Cash retained in the business over and above that required for trade purposes would be an accepted asset for these purposes. So again, it is necessary to watch the levels of cash retained. Many of the factors mentioned by Mark as to whether the cash is earmarked for specific trade purposes, etc., are also relevant here. So with all the above in mind, what are the tax implications for the current shareholders of giving shares to family members? And here I'm talking specifically about family members other than spouses or civil partners, where special rules apply. Well, we have seen that lifetime gifts of shares in unquoted trading companies should be able to qualify for BPR, so long as there are no excluded activities or accepted assets. Also, it is generally the case that no capital gains tax would be due on the gift of shares in a trading company, so long as both parties are UK resident and they both sign a relevant tax election. This means that the transferee pays capital gains tax on a later sale of his shares, as though he acquired the share for the same cost as the transferor originally did. So far, so good. One thing to watch, there are special rules called the employment-related security rules, which can pose an income tax charge when employees are gifted shares in the company they work for. Mark will go into these rules in a little more detail later, but there is no blanket exclusion in the legislation for gifts within families. Although generally HMRC will see gifts between family members as outside these rules, this is not always the case. For example, if a gift is given to a child who works in a business and an equivalent gift is not given to another child, or if the transferee's ownership of the shares is linked to him or her working within the business in some other way. It is always therefore worth getting advice in this complex area of tax. A couple of extra points worthy of note. Firstly, as Mark mentioned, it is important to ensure that the entrepreneur's relief status of family members are considered when gifts are made. Secondly, some business owners say they prefer to use trusts or other structures to protect shares they want to give away, for example, from a divorce in the future. We are not covering these structures in this webinar, but the rules are complex, and again, we would recommend you take specialist advice if you consider these areas further. It's perhaps also worth mentioning that as an alternative to gifts, shares can also be sold. This may seem a little counterintuitive, but generally these arrangements are used to fund the retirement of the existing shareholders. Essentially, the payments to the exiting shareholders are met out of the future profits of the company, providing a stream for those people to live off in the future. In certain circumstances, it may be possible for the funds to be taxed at lower capital gains tax rates, although this cannot always be guaranteed. Each individual business is different, so bespoke advice is required, but it's certainly something worth considering. Where business owners do not have family members who wish to work in the business, another alternative might be to to involve employees, and Mark's now going to look at this briefly.
Thank you, Sharon. Providing an equity interest to key employees is a popular method of rewarding and incentivising employees whilst also aligning the objectives of the employee with that of the company, namely to maximise the value of the company. Considering involving employees in the company ownership can be a key part of succession planning and could also be a precursor to a management buyout should you be considering allowing the existing management and employees to acquire the company from you. Where it is decided that the company would like to provide an equity stake to employees, the next question to ask is, how do I do that in a tax efficient manner? Employment-related securities rules can be viewed in the light of the principles behind the benefit in kind regime, meaning that where an employer provides an asset of value, and in this case shares, to an employee at a discount, then the value of that discount will be taxed as employment income and subject to income tax. This could be up to 45%. In the eyes of the employee, this will effectively be what we call a dry tax charge. Although the employee receives shares which do have value, the employee does not receive any cash, but they will have an income tax liability to settle as a result of receiving those shares. Share options are often used to defer this dry tax charge, so that the tax liability will not crystallise until cash is received by the individual. Share options are a legally binding contract between a company and an individual, giving the individual the right to purchase shares at a predetermined point in the future for a pre-agreed price. Enterprise Management Incentive, or EMI option schemes, are an example of a HMRC approved option scheme which is very popular in practice. HMRC approved option schemes often provide additional tax advantages such as the taxable value being subjected to capital gains tax at 20% or 10% if entrepreneurs relief is attained, as opposed to income tax at a rate of up to 45%. Linking back to my earlier discussion on entrepreneurs relief, often EMI schemes are structured so that employees acquire a relatively small number of shares immediately before a disposal event. This can cause an entrepreneurs relief obstacle. As you may recall, the qualifying conditions included the need for the individual to hold at least 5% of the share capital and voting rights for at least a year. Therefore, to provide the opportunity for EMI option holders to benefit from entrepreneurs relief, some of the qualifying conditions for entrepreneurs relief are relaxed for shares acquired under an EMI scheme. For example, there is no 5% requirement.
Thanks, Mark. Before finishing, I just wanted to mention a relatively new structure, the Employee Ownership Trust, or EOT. We like our acronyms in tax. There's a little diagram there that you'll be able to see on the right-hand side of the slide, and it might be helpful just to follow that through as I'm speaking. I know that employee trusts have generally had bad press over recent years, as sometimes they've been used for pretty aggressive tax planning schemes. However, the Employee Ownership Trust is a government-sponsored arrangement. It was introduced by George Osborne as a way to promote employee-owned companies, akin to the John Lewis model. In summary, it is possible for the existing shareholders to sell a controlling shareholding in a company to the EOT, and for that to be completely tax-free. You will see from the diagram that the owner is paid out of dividends then generated by the business. The EOP must hold shares for the benefit of all employees, but another advantage is that it can also pay a tax-free bonus to each employee of £3,600 per annum. In addition, the owner can retain some influence over the business by being a trustee of the Employee Ownership Trust. We're finding that these are becoming more common and something that quite a lot of companies who are thinking about succession and want to involve employees are considering. They're not right for all, but the tax-free disposal can make it attractive for some companies.
So that's the conclusion of our webinar today. And if I can provide a particular message to take away, I would say that there are some very valuable tax reliefs available to individuals seeking to pass on their companies. The key to maximising those tax reliefs is to have a clear vision of your long-term succession plans and to take advice far enough in advance that planning can be undertaken if necessary. Now, looking at the clock, unfortunately, we don't have time to field any specific questions. However, both Sharon and my details are included on screen, and you should feel free to contact us should you have any queries. Also on the screen is the detail of the next webinar in this series, which is entitled Selling the Family Business. I think Sharon gave it a mention earlier. That webinar will be broadcast on 21st of November, and hopefully you'll be able to join us.
Thank you.
Thank you.